and discuss upon this issue. So now I would request Dr. C. Nipun Agarwal sir to brief about Dr. Bakshi so that he can take this session forward. Thank you. Dr. C. Nipun Agarwal sir.
Hello, am I audible?
Yes, sir, you are audible.
Yes, sir.
Yes, thank you, sir. I, Dr. Nipun Agarwal, on behalf of SISTec MBA, would like to welcome our resource person, Dr. Avijit Bakshi, sir, Associate Professor, Finance, CMS Business School, Jain, deemed to be University, Bengaluru. Sir, I welcome you to this session and thanking you in the start only for taking out your time for our session. I would like to read first profile and acquaint all our listeners to his profile. Dr. Avijit Bakshi is a core faculty in the area of finance and accounts and an authorized PhD guide at CMS Business School, Jain deemed to be University, Bangalore. A PhD from Kalyani University, West Bengal, and a certified equity market professional from NSE. His experience in academia spans almost 14 years in several states. Before joining academics, he worked in organizations like Center for Monitoring Indian Economy, CMIE, and financial consultancy companies. His area lies in financial risk management, equity modeling, corporate finance, investment analysis, portfolio management, cost and management accounting, and banking. Dr. Bakshi has published papers which were presented in various international conferences, latest one being at Prague, Czech Republic, DEA 2017, and is credited with publications in reputed national and international journals, including scope of index journals. As a resource person, he conducted MDP on corporate valuation, FDP on option trading strategies, and also conducted several workshops on financial modeling, valuation of shares, etc. He cleared the courses on accounting, financial derivatives, and risk management in banks and financial institutions hosted by IIM Bangalore, IIT Roorkee, and IIM Bangalore respectively from SWAYAM or NPTEL platform. He also completed courses on simulations from Indian Capstone Simulations and Corporate Finance and Cost Accounting from Coursera. Sir, I welcome you again to this session. And without taking much of the time of our listeners who want to listen to our honorable resource person, I would please request Dr. Avijit Bakshi, sir, to carry forward the session. Thank you, sir.
Thank you, sir. Am I audible properly?
Yes, sir, you are audible.
Yes, sir. Yes, sir.
Okay. So, thank you, sir. Thank you, HOD, sir, Professor Somen Mitra, and the faculties of the Sagar Institute of Technology and Management for giving that wonderful opportunity and offered me a wonderful platform to share something which is recent past. It had happened in US, and I thought that that implication of that incident and what is the source of that incident, we should dip into that and try to investigate that what goes wrong actually that time. So that is why while discussing which topic we should discuss, I thought let's discuss something which happened recent past. That is that Silicon Valley crisis. Okay, so our objective of this session will be to deep dive into that crisis. Okay, and actually what went wrong and compared to vis-a-vis Indian story. Okay, where do we stand? Okay, so because of the paucity of time, I have removed that part 2008 crisis. I have also detailed analysis on that. Why did that 2008 crisis happen? Because 2008 crisis, it was so devastating and widespread its impact throughout the world. And the reason for that 2008 crisis, it was little bit complex because the little bit of complex financial product was involved. So because of the paucity of time, we have removed that part and focused only on that Silicon Valley crisis. Okay. So that is our objective of this session. Is my slide visible?
Not yet, sir.
Because I have
Now
already
it's visible.
visible.
Yeah,
Okay.
now it's visible.
So this is the agenda for the day. This will be the flow of the session. So first we will start with that conceptual brief discussion briefly, very briefly, about the banking risk. Okay. Next we'll talk about directly we'll enter into that Silicon Valley case. And lastly we'll try to understand that where do we stand. Okay. Indian bank stand. Okay. Now, let's start with that conceptual idea. Okay. So, if you see a banking organization and a non-banking organization means I'm not talking about the NBFCs. I'm talking about any manufacturing organization or trading organization or any other organization. So, what is the main difference between these two banking organization and the non-banking organization? Okay. So first, as you know that there is a difference in business model itself. Okay, the way this banking organization runs and the other manufacturing or trading organization runs, it is not same because the business model, that is the revenue model, cost model, it differs. Okay, for banks, our main revenue earns from the interest. Okay, where from that interest earned, it is earned from that either investing in the different loans and advances. The banks offer loans and advances, or it is through the investment. Banks also make a lot of investment. Okay, so from that investment they earn. This is their bread and butter, main source of earning. Vis-a-vis, if you see that non-banking organizations, their sale main this source of revenue, it is nothing but the sale of product and services. Okay. Similarly, cost also, if you see, there is a difference. Okay. Main the cost component for a banking organization, it will be the interest expenditure. Okay, because bank has to pay interest to his depositors, or the borrowings that he have taken, bank has to pay interest on that. But for other organization, non-banking organizations, the cost structure would be for their this raw materials purchase, or for purchasing of the product, or providing the services. What are the cost associated? So actually, the business model actually completely different between banking and the non-banking organization. Similarly, from the funding structure. Funding structure means where do banks get all these funds? Their major sources of funds are the deposits, unlike in case of the non-banks. So non-banks case, the major sources of revenue, it is their debt. Okay. So in case of banks, it is not debt. We cannot say directly it is a debt, but it is a deposit, either deposits or borrowings. Okay. Similarly, asset base. Asset base also completely different for these two organizations. Asset base also for the banking organization, it is the loans and advances and the investment. Either, and the in case of the non-bank organization, it is the fixed assets or different investment and all. Regulatory environment, since banks, this public sentiment is closely associated with the banking organizations. Therefore, the regulatory environment and the regulation are so very stringent for the banks, unlike in case of the other organizations. Okay, and the risk management, since the public money is involved, therefore, so many risk measurement and risk management tools are also applied in case of banks. Okay, we will now, out of all these differences, we will focus only on the funding structure, because our SBV crisis was somewhere related to that funding structure of the banks. Okay. Now, let's talk about the funding structure. Now, as you know, the banks are depending hugely on the debt. Debt means not in the debt form, but it is a deposit or borrowings. That is why banking organizations are called as a highly levered organizations. Okay. Since you have the high levered, means high obligations, that means you will have a high obligations, you need to pay to interest to your depositors, you need to pay to on time. That is very important. You need to pay depositors on time. When the bank, these customers will come for withdrawing their money, at that point of time only you need to pay. Okay. Otherwise, there will be a panic among the depositors. Okay. If you are not able to pay back to them. So it has got a high obligations. Okay. Since you have a high obligation, you have a high pressure to generate income. So problem starts from here. Okay. So as you know that, as we have discussed, that the income from the of the banks, it comes from either from that investment is made, or it is the loans and advances it made. Now, sometime what happens, just to generate more and more income, bank has to compromise their asset quality. That is why the deterioration of the quality of asset happens. That means banks are offering loan to some person or to some parties who doesn't qualify for the loan. Okay, that means lower rated companies or the individuals. Or banks might be invested in some assets that are high risky assets. Okay, just to generate income. Now, if something that happens, that means if something goes wrong, banks have offered loan to some parties and it stopped paying. Okay, that means the non-performing asset. The asset becomes non-performing. Or the investment where it has made, the instrument in which he has made the investment, that investment are running at a loss or incurring a loss. That time what will happen? Ultimately, your loss, it will absorb your capital. That means whatever the loss you are incurring, that will exceed your capital. That will completely erode your capital. That means your capital become insufficient. And ultimately, it results in a banking failure, or that is called the bank run. The SVB crisis was also somewhere linked to this problem. Okay, so this is very important. Your capital should be sufficient enough to absorb the losses. That is why, as you know, all these capital adequacy regulations and all, the Basel Committee and all. Okay, why these international bodies or RBI in our country, they are so very tight about these capital regulations? That means you should have a sufficient amount of capital to take care of all those losses if something happens. Okay. Now, let's take a glance about the risk. So these are the major risks are involved. Credit risks that we are discussing about, that banks are offering a loan to a party which who have failed to repay the loans. Okay, credit risk is involved. Market risk, it involves this interest rate risk or the currency risk, because there is a fluctuation of interest rate risk and credit risk. So our SVB crisis is related to this market risk also. Okay. Liquidity risk, as we are discussing, that bank should have enough liquid in his hand, because any point of time the depositors will come and ask for their money. They want to withdraw money. There might be, you are not anticipating someone to come on now, say premature deposit. My deposit is expected to mature on, say, at the end of the year, but 6 months before only I have come to withdraw my money. Okay. So bank should have the enough liquid also to take care of all those exigencies, emergencies. Operational risk, which is not covered, the risk which is not covered by the credit risk or market risk, like that, say it is related to that IT related issues or any kind of malpractices, fraudulent activity, it happens. All those risks are related to the operational risk. Regulatory risk, because since the banks are under very stringent rules and regulations, you have to abide by all these rules and regulations, and if you are slightly away from the rules and regulations, there will be heavy penalties important, and there will be a face loss in front of the investors as well as depositors, which will create a panic. Reputation risk: if you are not able to pay your depositors on time, the refunding their money, you will face a reputational risk. And legal risk, somewhere it is related to the regulatory risk. Okay, so banks are mostly exposed to all this risk. Now let's get into that Silicon Valley crisis. Okay, so these banks actually, it founded in '83. Okay, headquartered in California, US. Now, unlike the other banks, the Silicon Valley banks, its customers are slightly different. Its customers are mainly the startup companies or the technology companies, okay, or the venture capital or the private equity companies. That means one way they are, the customers are the startup companies, and who are funding the startup companies? Venture capital. So both these parties actually are the customers of Silicon Valley. Okay, and so its focus, it is only on these technology companies and the startup companies and the private equity venture capital companies. Okay, so actually they uh, provides the startup banking, the venture capital, and as well as the corporate banking. So the early stage startup, these are very risky. Yeah? The early stage startups, okay, they provide loans. Or the startup which have already passed few years and now it is more or less stable. At that stage also they fund through venture capital, different series A, B, C, and the normal corporate also, but their main focus is this area, startup and the venture capital companies. Okay, so their customers are, unlike in other banks, their customers or the profile of the customers are something different from the other banks. Okay, they are actually dealing with a very risky areas. Now let's get back into the numbers, what happened actually. Now, if you see, this data is taken from a report that is called the 10K report. What is 10K report? If a company is listed in US, okay, NYSE, then in their to their regulator, that is called as Federal Reserve, to their that is called this regulator of this US. It is called, the name I am forgetting, whatever. That they need to furnish the report to that regulator. That report is called the 10K report. So this data is taken from that report. That report is called the 10K report. It's very famous report. All the companies, they have to abide by this law. They furnish this detail. Okay, it is like our annual report, but it is so detailed. Okay. Now this is the 22 balance sheet. Okay, what you can see here. So as we are discussing the bank's asset side, it is dominated by the loans and advances and the investment. Okay. Now investment are of two types. Okay. And bank has to categorically differentiate these two investment. One is called the AFS category, that is called available for sale. What are the securities that are available for sale? And HTM category, that is called the held till maturity. Banks has to invest in all those securities. So banks in whatever securities they are investing, it is bifurcated into this. One is AFS category, available for sale. Any point of time they can sell all those securities. And there are some securities that they will not sell right now. They will hold it till the maturity. That is called, the name is HTM category. So total investment is, you can see here, 1,17,390. and their loans and advance, it stands at 74,250. Okay. Now, what is the normal prudential banking sense or prudential banking norms? That loans and advances, if you see any banks, Indian banks, the loans and advances are always more than the investment. You check, go and check any Indian bank. That is the prudential norm or normal banking sense. It says that your loans and advances are greater than the investment. But here you see, here it is just opposite. Investment are exceeding significantly the loan amount. Okay. Now, what are the repercussions we will discuss in the later. Okay. Now, this is one difference we can see. Now, next you see the loan portfolio segment. All these numbers, it is taken from the 10K, same 10K report. Just now we are discussing that their customers are mainly all those startup companies, early stage companies, and this private equity fund or this venture capital fund. Okay. Now, if you see here, it is their report I am putting here. Our lending to private equity or the venture capital fund represented 56% and 57% in 22 and 21. More than 50% of their loan portfolio is concentrated only towards the private equity and the venture capital. Too risky. We know that the normal prudential norms or the banking norm says that your loan should be bifurcated into different segments. Okay. So that if there is any loss in one particular asset, the other asset are there to take care of that loss. But here, more than 50% of their loan portfolio is concentrating only to the venture capital fund. And that to venture capital fund, as you know, are too risky, because venture capital fund, actually they are funding all those early stage companies or these growth stage companies. That is all those startup companies. Okay. Another significant flaw we can find. Now, next, if you see the composition of deposits of the bank, total deposit is this 1,73,000. You can see here. Total deposit can be broken down into two parts. One is called insured deposit, another is called uninsured deposit. What is that insured and uninsured? Insured deposit, that if the bank fails or bank runs, okay, close down the banking operation, in that case what will happen? All these 21,109, they will get back their money refunded. So Federal Reserve provides deposit insurance up to $250,000. In India, it is 5 lakh. Okay, if you are depositing in money, and something happens to that bank close down their operation, up to 5 lakh, you are tension free. It will be compensated through the deposit insurance corporation, this insurance corporation. Here you see, out of total deposit, uninsured is 88%. Uninsured deposit means their deposit are not covered by insurance. Federal Reserve will not come to save you. Okay. So if something goes wrong, this person will first get panicked and asking for their money or to withdraw their money. Okay. In India, comparatively, what is the ratio will come later. It is too high. 88% of deposit are uninsured only. Another flaw we can find. Let's check the next one. Now, we know the relationship. What is the relationship? the relationship between the bond prices and the interest rate. Okay, what is the relationship? It is the opposite relationship, negative relationship. If the interest rate rises, bond price will fall. If the interest rate decreases, bond prices will increase. Now, if you see the US federal rate from April 1, 22 to Feb 1, 23, you see that there is a sharp increase in the interest rate, in the federal rate you find. It was almost slightly more than zero in April 1st. But now it is here, you see, on Feb 1, where it is more than 4.5. Because as you know, the Federal Reserve gradually they have increased the interest rate in the US for last few months. Okay. So if the interest rate increases, the bond price will fall. Bond price will fall. So how does this bank will be affected? Because their investment. I have already shown you previously, their loan is lower than the investment. And where it's all those investment, this investment are made in all those securities. Okay. So when the US federal rate were increasing, actually their bond prices were decreasing. That means they are facing loss. Okay. So the repercussion you see, the impact you see here. What is the impact? Securities related losses. Okay. As you know, there are two types of deposit. One is the AFS category, available for sale. I've shown you. And the HTM category, held till maturity. Now, AFS category loss, if you see 1800, it is all are in $1 million. Unrealized losses on HTM category, 20,000. Okay. Now, you see why this HTM category loss is more than the AFS category. You just look at this table. So all these securities are called the fixed income securities. Okay. Now there is a concept called the duration. What is the duration? Duration is the sensitivity of the bond prices. That is very important for the banks. Because all these banks, they mostly invest in all these fixed income securities. No? So the risk, how much risk all those securities possess, actually it is measured by this duration. That means how much it is interest rate sensitive. That means if there is any 1% change in interest rate or say increase in interest rate, how much your fixed income securities or bond price will fall, and vice versa. So high sensitivity means there is a high chances of loss. This is a concept in finance, duration. And weighted average duration, there are calculation we can calculate. Now, if you see the total fixed income securities portfolio, their weighted average duration is 5.7. AFS category, it is 3.6 only. That is why loss is lower, you see, 1800. Here, the duration of HTM category is 6.2, almost double, close to double. That is why loss is also significant. Following? Now, there is another concept that is called the MTM loss. What is that MTM loss? That is called mark to market loss. That means every day price is changing and every day Someday you are incurring loss, someday you are gaining. So it is showing your day-to-day position. So this number, it is actually the MTM losses. But if you see, one is called the realized losses and another is called the unrealized losses. What does it call this unrealized losses or realized losses? Because since it is AFS category available for sale, that is why this loss you have already been made 1800. But this loss, it is not because these securities will be held till maturity. No? That is why all these losses are not realized actually. These are unrealized losses. Banks have not actually incurred losses. This is the hypothetical losses. That is why unrealized losses. Okay. Now, why I am taking the references of these MTM losses? No, this prudent banking norm, what it says that if you are there might be some MTM losses or mark to mark losses, but you have to make the provision for that losses. In Indian banks, they always make this provision to take care of all these MTM losses. That is called the investment fluctuation reserve. Okay. So in US, there was no such regulation, okay, that you have to make this investment fluctuation reserve or this kind of provision to take care of these MTM losses. Okay, that is why SDB, they also didn't maintain that provision for MTM losses as it is not compulsory. Okay. Now, another interesting point, if you see, the unrealized losses is 21,800. And if you see their liability side, what is the equity size of this company, of this bank? Only 16 to 95. Okay. The loss is 21,800, but their equity size is only 16,000. That means this loss is actually eroding your capital. Your capital become insufficient. This is the problem we are talking about at the beginning. Whenever there is a pressure to generate income, you will make some investment. Whenever the investment are not performing as per the desired expectation, then what will happen? You will face losses. That loss can be, that accumulated loss can erode your capital. Okay, the same thing happens. Okay, same thing happens. Okay, now, so as we are discussing that 88% were unsecured deposit, so automatically there will be a panic to withdraw the deposit. The same thing happened to this SVP. So they face problem because all of the business customers, all as you so know that there are these startup companies, early stage companies for running day-to-day business or day-to-day payment. They want money, so they are queued in front of the banks. But banks, so there is a panic. That is the same point we are discussing at the beginning, that banking organization, why is it so risky business and why there is so much of stringent rules and regulation by these local regulatory bodies, either by RBI or these internationally acclaimed the Basel norms. Why it is so stringent? Because the public money is involved here. That means at any point of time when they will got panicked, automatically it will hamper their confidence on that bank. So once that confidence is shattered, the existence of the bank will come into a question. Because just try to understand one thing, the banks, any bank, it runs on the assumption that all my depositors will not come to me in one day to withdraw their money. Actually, the banking business runs on this assumption that on any particular day, all the customers will not come to the bank to withdraw their money. If this happens, it will be a problem for the banks. The same thing happened to SBB. Or for any bank, it might happen. There are also some Indian instances, same thing happened. That is why keeping the public confidence on the bank, it is very important. Because if all the customers come to you to withdraw money at one point of time, you will be in trouble. Okay, that is why all these this asset liability management and all that is required. Okay, we are depositing our deposit in so many time period. We are classifying all our assets or the loans and advances in different time frame. This is the reason that today at the end of the day, what is my obligation? After 1 week, what is my obligation? After 1 month, what is my obligation? Or vice versa, after 1 day, what is my expected cash flow, inflow? But at the end of this month, what will be the expected cash inflow? This calculation or this management or this asset liability management is so important for the banks. Okay. Now, let's take a look on that Indian story quickly. Indian story, if you see, we are safer and we are comparatively better position. We should be thankful to our regulatory bodies or RBI. They are so stringent. Okay, unlike in case of this US. Okay, so conservative. Sometimes this conservative approach it works. It is important for this public confidence. Well established banking practices, robust our norm, all these prudential norms and all are very robust, and limited exposure to toxic assets. That means all these derivative assets and all, that is the main culprit behind the 2008 crisis. Okay, so we are slightly, Indian banks are slightly away from all this exposure. Now, if you see the numbers, our capital adequacy, just now we have seen how capital is important for a bank, for sustainability of a bank, how capital is so important. If you see the numbers, CAR ratios for the public sector banks, 14%, then 14.7%. As a bank as a whole, more than 16%. Okay. Gross NPA ratio also it is decreasing. Slippage ratio also it is decreasing. Okay. Liquidity ratios, as we know, it is very important for the bank. So liquidity ratio is measured through this net stable funding ratio. How much stable fund you are having? Stable fund means that fund will not ask for withdrawing tomorrow only or today only. The fund that we can depend, that those funds will not come to me as an obligation. Okay. So this RBI has made all these. These are all internationally acclaimed ratios. All the banks they need to maintain all these ratio, net stable ratio, more than 100%. That means we have the enough liquidity. All our Indian banks have enough liquidity to take care of all these exigencies. Okay. Now that insurance deposit coverage that we are talking about, it was 88%, as you recall the number, 88% uninsured deposit in Silicon Valley Bank. That was the one major reason behind that crisis, behind that bank failure. Comparatively to India, it is only 49% of the total deposit are uninsured. Okay, comparatively better position. And our deposits are covered up to 5 lakhs. Vis-a-vis in US, it is covered up to $2.5 million. $2.5 million. Okay. Now, Now, what is the solution? Solution, some argue that all the banks should be privatized. Okay, this should not be the solution. Okay, that means in any crisis, or like the 2008 crisis, or in India also, we have passed on several crises. Whenever this crisis period comes, this happens. That means it is our money that is taken care to compensate their loss. Okay, that is a cost and risk are socialized. Okay, when it is loss comes, then we have to segregate the loss among the masses. That means we have to socialize the loss. But when it is profit, they forgot to socialize the profit. Okay, so this should not be the approach. Okay, and this is the way I want to conclude it. If there is any doubt or something, clarification it is needed.
Yes, sir. Thank you very much. You have wonderfully covered all the aspects which led to this crisis of Silicon Valley Bank. I think one aspect needs further attention, which was probably the stock price reaction of the stock prices. I think which also added to this crisis, the panic which was created and the rush which happened with the investors to pull back their money. Maybe probably the stock price downward movement was also cause of concern. Although it was an after effect, but it is also probably an indicator. What are your opinions on that?
Yeah, actually, automatically when the bank runs or this bank fails, automatically there will be an repercussion on the stock market. Okay, this is so automatic. It has to happen, and it happened not only in that particular company stock, so it will impact the others also. Okay,
Right.
so that is why in US market that period also we have faced, and Indian market also we have undergone that phase, that pass. So this is an after effect. That is why this is not falling of the stock price is not the reason for SBB
Yeah, yeah.
crisis. So that is why
True.
I have not discussed that part actually.
True. After carefully looking at the entire case, somewhere it gives us an impression that they failed on the norms, they failed on the portfolio management, and also they failed portfolio management. They failed heavily because of the you can see from the bond price movements also that their average portfolio maturity was high for the HTM assets, so HTM securities. So it further actually contributed to the losses. And I think in their portfolio, they were funding too much to those businesses which were very nascent in stage, very nascent, and the startups and venture capitalists. It was overexposed. From the feel of it, it appears that it was overexposed to those sectors. So
Actually, the
would this,
banks are made for all to take care of all those sectors only.
yeah, that's
It's not
true.
that they provide the loans in other sectors. No, they focused only on those that particular sectors.
Yeah, but from the 2008 crisis, which was the subprime crisis fueled upon housing loan bubble burst, they should have taken a lesson. As it
Yeah.
appears prima facie, because it was also based on skewing in one particular sector. In this case, it was basically this startup enthusiasts who had can't open their accounts, who took loans also, and these loans formed a good segment of the portfolio. And obviously, the second part was the investment, and the investment in securities was astronomically higher as compared to the loans and advances. This is also an eye opener. So, what are your views on the US banking regulator? Like in India, we have a lot of prudence in terms of the RBI regulations. So, what is your opinion on the US regulator prudence?
Our regulator, the RBI, they are much more stringent, much more prudent in what is called this take care of all these banking issues or banking problems that might crop up. Because the 2008 crisis, we have a great example of 2008 crisis. The 2008 crisis, that is called a systemic loss. Systemic loss, why is it so? Because it was not concentrated only on US. It was a far-reaching impact throughout the world, except India. So Indian banks are not affected significantly because of this from this 2008 crisis, and for that we should be thankful to RBI, because the point that I have lastly included, the Indian banks were not exposed to all those exotic assets. Exotic assets means, I mean to say, all those derivative kind of products. So there no Indian banks, might be there 0.001%, that is a negligible amount it was involved in that. But in other parts of the world, if you see, that moral, because it was making all this part I have not discussed, otherwise you would have seen those who are in that line, in the chain, all are making money because of the housing price. Okay, but once that bubble burst, and again the same scenario, that interest rate relationship, it also works there in 2008 crisis also. Now they have to face the loss, but Indian banks, didn't need to face the loss. So that is why we need to thankful to our RBI that they have restricted Indian banks to expose towards all those assets. But if you see that US banks, the regulator, they were not so they have not taken a very good lesson from the 2008 crisis. Okay, that is the difference between an open economy in true sense and not an open economy like Indian economy, where the these rules and regulations are so stringent. So sometimes where the public money or public this confidence is involved so closely, stringent norm is very much required, and all those international regulatory bodies, they should take a lesson from our country or RBI.
Sir. Uh, Tina ma'am, you have any other questions or any questions from faculty side?
No, sir. Thank you, sir.
I received one question from student aspect. Can you deliberate little upon the asset liability management briefly?
Asset liability management. What are the assets of a bank? The loans, major
Loans
assets,
advance.
the loans and advance, and the investment. Okay, fixed asset and all, it is not very important for the banks and other organizations. Students make a mistake applying all the ratios that are applied to non-banking organizations. They apply also same current ratio, fixed, all these ratios in banks also. Now, so that all those assets, as well as what are the liabilities of a bank. Liabilities are the deposits and the borrowings of a bank. Now they divide all those asset and liabilities in different clusters or different time buckets. Time buckets means, say, what are my deposits that will be matured in, say, 0 to 1 day. How many deposits will be in amount? Deposits will be matured, say, in next 1 week. How many deposits will be matured till, say, 1 week or 1 month or 1 quarter or 6 months, like that way. Similarly, on asset side also. Okay, that will be in time. When you are dividing the asset and liabilities, you are dividing or segregating or classifying your asset and liability in different time buckets. So as you know that at the end of the day or at the end of this week, how much is my expected cash inflow, and at the end of this week, how much is my expected cash outflow. So if there is any mismatch, if you find that my outflow will be more than inflow. So automatically you can arrange for some money to take care of that. So that means all this we are classifying in different time buckets just to, it is a kind of preventive measure so that in advance we will be ready if there is any insufficiency or shortfall is there. Okay, so the fund can be arranged in advance. So we will be ready in advance rather than if we find one fine morning, if I find that my assets are become or this income, the inflow of cash is become lower than the outflow, then this type of situation will happen. This type of situation means the panic among the investors because this kind of news, it spreads like a fire. It happens in India also in some banks. Okay, some cooperative bank, this in Maharashtra or Pune based, some cooperative banks also 1 or 2 years back. And few years back, about 10 years back in India also, one private banks it happened, same situation. So here in banking business, keeping the public confidence or faith on the bank, that is very important. Once this confidence or this faith or trust it is shattered, you will face a problem. Okay, that is why classifying your asset and liabilities in different time buckets, it is so important so that you will know in advance that how much there will be shortfall or if there is any excess in your cash. That is the main objective of ALM or asset liability management.
Thank you. We have
So
another question.
there's one question from our student side. Who are the biggest investors in Silicon Valley Bank?
Same here. Actually, what happens now in Silicon Valley, these uh, customers can be of two types. Now, either they will be depositors or they will be this to whom we a
Borrowers.
bank have provided these loans and all. Both the sides, there are all these startup companies, all these this private equity fund, okay, technology firms. That is why they call themselves as a technology based business name. That is why it is Silicon Valley, because they are exposed to that particular sector. Okay.
We also came to know that there were a lot of Indian startup companies in this space who were into technology startups. There were a lot of Indian startups also who
Some
funded.
Indian startup also they are having account in SBV. Some
Yeah,
Indian startup also, very few,
true.
but it was there. So they have
True.
also faced problem because of that SBB for day-to-day running operational expenses. They are not getting money from the bank. They are not able to withdraw money. So that way also they have faced the Indian startup also. Few startups, those who have exposed business with that SBB, they have also faced the losses.
Okay. There was some question also regarding some foundational concept about the duration management. If you can put it in a
Uh,
layman form.
Duration, as we know, say duration is say 4. That means if there is any, the relationship between the this interest rate and the price of the fixed income securities or bond. So 4 means if there is any 1% increase in the interest rate, 4% drop in the fixed income price, and vice versa. If there is any 1% drop in the interest rate, 4% increase in the fixed income price of the bond price. So how much it is sensitive? That is called interest rate sensitivity. Bonds are very interest rate sensitive. Now, every time you see that bond prices changes, fluctuates. Because of what? It is directly impact, this depends on the interest rate. Okay. And there is a method called the weighted average duration calculation. You can calculate the duration of a particular asset class. You can calculate
So
that
it's a
duration.
dynamic management of the maturity of your portfolio, basically, and obviously it's a very important aspect of fund management, or
Yeah.
because it's a very specialized kind of a job, and it can happen both ways when the interest rate is going southwards or the interest rate is going downwards. And the most important part is that how well in advance the managers, the fund managers are able to gauge it and they act upon it in advance. Because when it comes, then it is a reaction based strategy. But if they can do it in advance, if their approximations are close to correct, then they have better results. And we have seen fund managers differing from each one from another, sheer by their sheer individual brilliance on these aspects. Otherwise, the economy offers the same kind of situation to everybody. uh, Tina ma'am, any other question you are having?
No, sir.
Okay. Anything from faculty side? Okay. I
Questions?
believe then we can go for the vote of thanks. So I'd ask Tina ma'am to propose the vote of thanks.
Thank you so much, Dr. Avijit Bakshi, sir, for providing such a valuable session to our students. As you included funding structure, risk management, and a proper detailed discussion about Silicon Valley Bank case, this would definitely help our students in their future. I would like to thank our students and faculties who have participated in this session. Last but not the least, I would like to thank our head of the department, Professor Sumin Mitra sir, for always organizing such a valuable sessions for our students. Thank you so much, Madhu Kushwaha ma'am, for providing us StreamYard support. Thank you everyone. Have a nice day.
Thanks.
Thank you.
Thanks
Thank
to
you.
all.
Thank you
Thank
all.
you so much, sir. Have a good day.